Hello and a warm welcome to this quarterly update from SKAGEN Global. Portfolio manager Knut Geselius has joined me in the studio, and first of all, Knut, it has been kind of a rough quarter, hasn't it? What has happened?
Yeah, I think it's fair to say that this has been a challenging quarter for us in the third quarter here, and there's been basically three different factors contributing to a challenging performance. Number one, the biggest position in Samsung has been weak. The stock is down about 15%. Second part is the Russian market. We've been taking a few hits on that one. And the third one is the underperformance for our fund in the US, given that we have an underweight in the US market. So when the US market does well, that means a negative impact on a relative basis for the fund. So those are the three factors explaining it.
Okay, let's have a look at the results.
Yeah, so if you look at the third quarter here for the fund, we're up about 1% in absolute terms, but on a relative basis, we're about 5 percentage points behind the index, and that is, like I said, explained by those three different factors. And we're obviously not happy with that type of performance in the quarter, but we're looking long term. We're continuing to pursue the same investment philosophy that the fund has had for a long period of time, and we think that over the longer run, we'll get back to the good performance.
Mm-hmm. What are, in your opinion, the most shall we say, difficult tasks ahead?
Yeah, I think always when you have a situation where you're being essentially hit by different factors, you need to kind of keep your head cool and come back to the situation, go back to where you have your basic investment philosophy and not change what you have done in the past, but really go back and make sure that you have conviction in your ideas and making sure that you have the ability to go in and make sure you know what position you can keep in and what position you need to beef up on.
Mm-hmm. Stick to the plan, really.
Exactly.
Mm-hmm. All right, let's have a look at the markets in the third quarter.
Yeah, so if you look at the market in the third quarter, the ones that have done well, we've had China doing really well in this quarter. Obviously, though, a big portion of that market is due to FX. Other markets which have done well have been, for example, Thailand, India, and Indonesia. And I'd like to say those have been markets where there's been a political change, a democratic one. That's not quite true for Thailand, where there's been a military coup, but it seems that the market is appreciating the stability in that market. For Indonesia and India, we've had obviously more market-oriented governments come into place, which have been pushing up those markets. On the bottom end of the chart, Russia is dead last, a negative 9%. Not a surprise given what's been happening with the Ukrainian conflict. We've had sanctions. Russian economy looks challenging. We think there's probably not going to be any GDP growth this year. Inflation at around 8–9%. So that obviously kind of keeps a negative sentiment on that market from investors.
Great. Main contributors then. Who has sort of been on the positive side in a troubling quarter?
Yeah, so looking at the fund year to date, we start with the positive contributors. Obviously, Citigroup is the one that has been the best performing stock this quarter. And we have had a differentiated view on Citigroup for quite a while. And it looks like the market is now beginning to come closer to our view on Citigroup. Our view is that we think there's a lot of capital that can be released in Citigroup. And we think that the two parts of it will do a lot better. Citigroup, as you might remember, is split up into a bad bank and a good bank. And we think the bad bank will be turned around and performing better more quickly and to a higher extent than the market expects. And what we saw in the third quarter now was that the bank, the bad part of Citigroup, is actually profitable for the first time since 2008. So that has good implications for the cash flow, and it will also release more capital. And the market, I think, is beginning to realize that, and that has pushed up the share price of Citigroup. The second best contributor was LG Corp, the Korean conglomerate. Here there are two factors behind that performance. Number one, we've seen good performance, better than expected performance from two divisions, the semiconductor and the IT one. And the other factor is that the brand royalty, so the payments being made by the subsidiaries in LG Corp to the parent company, will probably be increased by the end of the year. At least that's the market's expectation. So those have been positive contributors. Then if we go to the negative side, like I said in the beginning, there's kind of two big themes running through this list. Looking at the list here, you have the Korean theme and the Russian theme. And if we start with the Korean one, actually, with Samsung being the biggest position in the portfolio, over 7%, that has been negatively impacted essentially by mobile phone margins being driven down. And what we see, basically we see a squeeze both from the up and from below. And in the kind of upper end, that's the high-end segment, you have Apple coming in, eating up the market share that Samsung has. On the lower end, we have cheap Chinese manufacturer coming in and competing on price. So that has obviously been bad for Samsung on both ends. The other part that's been worrying the market, which is related to Hyundai Motor, number 4 on the list, is that we've seen in Hyundai Motor in particular very poor and irresponsible use of capital. Basically what happened in the third quarter was that Hyundai Motor, they spent $10 billion on an acquisition of land, buying property at a price which was 3 times higher than the book value. So that is obviously not very good corporate management or capital management. And we had expected that the net cash that the Korean companies have on their balance sheets will be used either to boost dividends, for more share buybacks, or investments into profitable kind of high returning plants or R&D, but not spending 3 times book value on plant acquisitions. So I think that was bad for Hyundai Motor, and I think it also spilled over to some extent to Samsung, because Samsung has almost 30% of the market cap in cash, and that worried investors a lot. The other kind of negative thing here was the Russian theme, and if you look at this list, you have 3 different Russian companies, C2C Media at the bottom, Gazprom and Sistema. With the Russian markets going down, obviously all of those were impacted, but I think Sistema is probably the one that stands out because it's been a huge hit in the market. I mean, the stock is down 70% year to date. And the background here is that Sistema is a Russian holding company. It owns oil assets, telecom, a toy store, some transportation assets. And what happened in the third quarter was that the main owner and the chairman, the oligarch Vladimir Yevtushenkov, was put in house arrest by the government, accused of money laundering. And there was also a criminal investigation into Sistema's taking over of the oil assets. And this obviously sounds a little bit like the Yukos case with the previous oligarch Khodorkovsky. We think that's a faulty comparison, because what happened in the case of Yukos was that Khodorkovsky, he had explicit political ambitions to challenge President Putin for the power. If you look at Sistema, the oligarch Yevtushenkov, he hasn't had any political ambitions. In fact, he has been good friends with Prime Minister Medvedev in the Kremlin. So we thought that risk is obviously much, much lower for Sistema. So we don't think there's a fair way to compare these type of situations. But nevertheless, there's been a big worry in the market that the oil assets will be confiscated by the Russian state, or perhaps bought but at a big discount. And that has obviously brought down the value of the Sistema shares a lot.
But I mean, the theme of political risk isn't new, especially when it comes to Russia.
Yeah.
How do you consider that now, in the light of Sistema?
Well, I think what has happened has been sort of we're kind of entering a new territory where we have the Sistema risk, like I said, being driven by something that is kind of out of the blue, given the close relationship that oligarch had with the Kremlin. We also seen a couple of other kind of very anti-business, anti-Western laws being put in place. For example, for C2C Media, we had a new Russian law come into place that limits foreign ownership of media companies to a maximum of 20%. Clearly that's a negative for someone like C2C Media. So in light of this, the equity risk premium in Russia is obviously going up. But a number of these events have been, I think, they have been much harsher than the market expected. And that's obviously reflected also in the poor performance of the Russian market, of the Russian ruble, which has tumbled to a multi-year low at this point.
That leads us on to the largest holdings in the portfolio.
Yeah, so looking at the next list, I mean, we have Samsung Electronics, and we think that that's still an extremely strong company. It's well positioned, it has a good cash, and it did spend some of the cash in the third quarter, not on land, but on actually buying a fabric or setting up a new plant for production, which is positive. We're happy with keeping that position high. We have a Citigroup that I touched upon before, looking very strong from here onwards. And then we have AIG as the third largest position. AIG is an American, it's an American base, but it's a global insurance company which has come back very strongly from the financial crisis when it was bailed out by the US government. and we see this one as a strong brand, well positioned, a lot of excess capital, benefiting from a healing US and global financial system with a number of company-specific triggers to unlock value in that company.
Mm-hmm. Interesting. You have done some changes in the quarter, haven't you? Let's have a look at them.
Yeah, so if you go on to the next slide, you can see kind of what we added. If you look on the left-hand side of the page, we added a couple of new positions. Volvo, the Swedish truck manufacturer, and a life insurance company in Holland called NN Group. And then we added to some of the positions, for example, Gap and Philips. These are positions that they came back a little bit on some short-term noise at the end of August or early September. So we thought there were some pretty attractive levels to increase our exposure in those two names. Looking on the right-hand side of the slide, where we have the holdings that we reduced this time, we had, for example, we took profit in names like RSA, Weatherford, Hanover Re. They had come closer to our price target, so we took some profit from those. And we sold out of a few positions, for example, RCL, Royal Caribbean, the cruise liner. This is an example of a stock that we bought about 2 years ago for, I think, around $25, so in the summer of 2012. It has now re-rated and it trades above $60, so it had hit our price. We thought it's still it's a fine company, but from a valuation point of view, we wanted to deploy our capital into opportunities where we see more upside at this point. Just another example, Vale, the iron ore producer. This is the one that has been obviously challenged by the fact that iron ore prices have been sliding for a while. And when we look at the stock price at these levels, iron ore is now trading at around $80 per ton. We think that the market is actually pricing in a pretty sharp recovery into the iron ore price. So in other words, even if iron ore stays at $80, that wouldn't be enough to justify today's share price in Vale. And given that we don't see a huge sustained recovery in iron ore prices, we don't want to have that exposure at these current times.
Mm-hmm. All right, now to the Swedish pride and joy, Volvo. Let's have a closer look at that.
Yeah, so just a few quick comments on Volvo that we took into the portfolio here in the third quarter. It is a large Swedish truck manufacturer. It is competing in the high-end segment of the market, about 12% market share. And there are two things that we think are underappreciated by the market. First one, and the most important one, is a restructuring story. Volvo has been going through a restructuring period since 2012, but the results haven't really shown up yet in the financials, and we think that the management team hasn't taken sufficient action to really dig into the cost-cutting potential of the company. Looking at the workforce, you still have more than 50% being white-collar workers in Volvo. So we see a lot of potential for more cost-cutting in the program from here onwards. That would be a huge driver of profitability of the company. The second part is the order intake and the trucking. We realize that trucking orders right now, they're kind of in some markets just above the normalized level, but we see a cyclical element to this. So when the market starts to come back, that will be an upswing, an extra increase in the production and in the profitability from that part of the market. And this is not a 14 story. This is more something that we'll expect to see in 2015, maybe even 2016. So kind of as a long-term investor, we don't know whether the next quarter is going to be when it really takes off, but we think when we look out 2-3 years from here onwards, Volvo will be trading significantly higher than the current share price. We see at least sort of 40-50% upside from here onwards.
Thank you very much, Knut. That's really interesting. Now, I would just like to remind you all that if you have any further questions, do not hesitate to contact us. And I would also like to remind you that we have a brand new market report online now for you to read. So should you have any questions or want to read anything else about our other funds, do not hesitate to download it. All right, thank you very much, Knut, and thank you very much for watching.
Thank you.